On behalf of Auburn University's Harbert College of Business and the College of Architecture, Design, and Construction, thank you for joining our 2021 Capital Markets Forum. I'm Greg Bass, Marketing and Communications Manager for Graduate Executive Programs. I'd like to welcome our attending audience and our esteemed panelists. Tonight's webinar is presented by Auburn Citybuilders, an industry outreach of the Executive Master of Real Estate Development Program. I'm joined by Dr. Justin Benefield, the Walker Reynolds Bickerstaff Associate Professor of Finance and Director of Auburn's Master of Real Estate Development Program. Dr. Benefield has a few words about the Mred program.
Thank you, Greg. This is the first of these events since I was named the new director of the Master of Real Estate Development Program, and I am incredibly excited to be here in this role. I would like to thank Professor Michael Robinson for all his years of hard work and dedication in starting and building this program. As we like to say in the Mred program, see what others don't, build what others can't. Michael certainly did, and we all thank him for it. The Auburn Mred program is a 5-semester joint program between the Harbert College of Business and the College of Architecture, Design, and Construction. Joining design and construction and the business of real estate may seem obvious, but the program is actually fairly unique in collaborating across those areas. Our program is a hybrid executive program, which means students are on campus for 1 week at the beginning of each term for what we call a residency. The remainder of the semester is taught via a distance platform. There are also 3 domestic field studies and 1 international field study in which the cohort travels to a city and engages in several site visits, touring interesting recent developments. Spending 5 semesters in a cohort-based program obviously provides students with many networking opportunities within their cohort. We pride ourselves on expanding those networking opportunities beyond a single cohort. After all, the Auburn family is an awfully big group, and industry connections are an important part of the Mred program. Another thing we pride ourselves on is providing useful content for those industry partners. Tonight's webinar is being hosted here at Auburn University, but will be shared with real estate professionals across the country. With that, I'm going to turn it back over to Greg.
Thank you, Justin. We have one housekeeping item to share. Following the panel discussion, we will open a question and answer session. We invite you to submit your questions at any time using the Q&A function at the bottom of your screen. We will answer as many of your questions as possible during our live broadcast. With that, let me introduce our moderator, Donald Sheets, who is an Auburn University professor and managing director of Broadshore Capital Partners. He is joined by panelists Victor Calanog and Darrell Wheeler, both with Moody's Analytics. Dr. Calanog heads commercial real estate economics for Moody's. Prior to the acquisition by Moody's in 2018, he served as chief economist and senior vice president of REIS, where he had a team of economists and analysts to build, maintain, and customize the firm's marketing, forecasting, valuation, and real estate portfolio analytics and advisory services. Darrell Wheeler is a senior director of CMBS research and analyzes real estate loan performance using commercial real estate market data. He has more than 30 years of experience in real estate and structured finance research, including managing and securitized research efforts at Cantor Fitzgerald, S&P Global Ratings, and Citigroup. We're excited to have these esteemed panelists for our Capital Markets Forum. Donald, I turn it over to you.
Thank you, Greg. Thank you, Dr. Benefield. Congratulations on the recent appointment. I think we're all excited to see where this next chapter of the Mred program continues to build after Michael's strong leadership and launch of the program. And in advance, Victor, Darrell, thank you very much for taking some time from busy schedules, particularly at this time of year, to join us for this. And hopefully we'll get some good discussion going centered around the commercial real estate capital markets. Lastly, I want to thank Greg Winchester as well for his leadership in putting the Citybuilders series together and keeping it going. I think it's been a great benefit, particularly during this time when we can find some additional engagement points to alums and friends of the Auburn Mred family. So with Victor, we'll put you in the hot seat to begin. Where do you think commercial real estate markets have fared, particularly, through COVID? And I don't quite want to say after COVID because, we could end up jinxing something here, but give us perhaps a thumbnail on CRE markets, where you're seeing them.
Thanks, Don. Oh, I get to go first. This is great. Now, I tend to define CRE markets either by geography or by property type. So let's talk about geography first. We had a lot of large urban markets by virtue of their density, first and foremost, being hit by the pandemic early in the process. I mean, you folks remember those horrifying numbers from New York City in the very beginning. So these large urban markets tended to have sustained really big drops in performance metrics. We registered record effective rent declines, for example, for multifamily markets like New York, San Francisco, Washington, D.C. for calendar year 2020. Now, we had other smaller markets we might classify as secondary or tertiary, posting some negatives as the pandemic became more widespread throughout the country, but nowhere near as large as some of the urban markets that I just mentioned. Second, that aspect of timing is important for geographies that experimented with relatively looser versus stricter lockdown rules. No surprise, we saw markets in Texas and Florida register somewhat less distress because economic activity wasn't as curtailed, or at least it was loosened up sooner relative to other geographies. Now, once you focus on property types, the hospitality sector knew very little geographic boundaries, massive declines in occupancy across the board. Our national occupancies went from 65.1% at the end of 2019 to around half of that, 36% or so, by the middle of 2020. We are now back to at or around 60%, believe it or not, but let's see what happens over the course of the year and next year. There were some property types that benefited from the pandemic, most specifically logistics warehouses and self-storage units. In retrospect, I guess it was obvious that these two property sectors would shine given the shift to e-commerce that the lockdown accelerated and the amount of movement from households and employers that economic dislocation prompted. I mean, you gotta store that painting from grandma that you couldn't just Marie Kondo, right? So that's a plus for self-storage. What remains in limbo, I think, right now are retail and office properties because of fundamental shifts in buying and working that are still playing itself out, and that I'm sure we will discuss throughout this session. So I'll stop there because, as you know, I can talk for 2 minutes or 2 days, and I'd love to hear from our other guests like yourself and Darrell Wheeler. Thanks, Don.
Sure.
Back to you.
Absolutely. Thanks, Victor. And so, Darrell, I mean, obviously in the CMBS market, there's a fair amount of transparency as well in reporting data. Sometimes has a lag to it. So I think Victor's painted a picture of kind of what's happening through COVID. Is there any trend line that you're seeing in some of that data and what that might extrapolate in terms of what today and maybe let's call it the next few months might portend in terms of some health and perhaps something counterintuitive? Anything catching your eye that might not fit that anecdotal pattern, or where some of us might have expected to see more severity or less severity?
Okay, tough question. We've been tracking, and everybody reports on delinquency every month, and it went up as high as 12% or 10%, depending upon how you report it. And then, ever since really last August, everybody's been reporting that one coming down. And if you were to track that, you'd think that markets were recovering, when in fact you could probably draw another line just for the amount of forbearance going on, and really the amounts have sort of stayed stable. So you're thinking, okay, we're kind of stable with the affected loans. But if you actually looked at the pace that they offered the forbearance, and with the regional nature of COVID and how certain regions were hit first and now have kind of rotated through as much forbearance as they could get and are now performing, there's actually almost 40% of the wholesale sector, I think it's 44%, that we track that got troubled by COVID. Another almost 20% of the retail market got hit. So whereas you're hearing numbers that are approaching 7%, 6% sort of delinquency, the number of loans out there that we're able to track are just it's almost half of the CMBS universe at this point. And although we shouldn't, we do look at the quarterly financials that come through. And you can see that if I took them in 2020, there was a fair chunk of them that were less than 1x debt service coverage. And in the last few quarters, for the ones that have reported, we've been able to see them increase into the sort of 1 to 1.5 debt service coverage area, so they can make it. And then some of the ones that were less than 1.5 have progressed up into the 7s. Some of the ones that were over 2 have come down, actually. We're following what is a real mixed bag of stuff going on. And I can't say that it's good enough. If I was to look at the average debt yield, like we also track the loans that cured since August of 2021, which there's 612 of those. You know, those ones are really not great stories either. If you looked at the average debt yield, it's about a 7.4, and that's an average. There's a huge variance around that, obviously. So we're expecting that this story is going to take a long time to roll out. It's going to really depend on the types of things Victor was just mentioning. Are we all going to be working from home? Is the real long-term demand for office going to show up? You know, how much retail is now shifted to industrial warehouse? A variety of factors. So I really can't tell you that there's one to be tracking, but what we are following is sort of that debt service coverage to see how it's going to progress quarter by quarter. We'll be waiting for the third quarter. There's also a lot of these loans that cured that just aren't reporting at all. So we've got a huge chunk. Normally that's an indication of something negative. So there's a huge part of the universe that, although you talk about the information flow being really good, is still kind of a black box, even to people with their hands right on the box. So not necessarily the clarity that you'd like to have at this point. Most people treat that to sort of price to a worst case scenario when they're using and looking at this stuff, whether they talk about CMDX indexes or whatever, if they're an investor in the credit. But I don't want to use too much. I don't know what your next, I'll hold some back for you.
Yes, absolutely. No, it's all good. We're going to kind of organically get through some of these areas. I think that's helpful, Darrell. You know, we've also seen, you know, some inconsistency as well, given all this forbearance activity of even how loans are getting classified as performing or non-performing. I mean, a loan in forbearance, at least to an investor, or, you know, that tends to be looking at paper, that's not really a performing loan, but that's not a uniform approach in the land of servicing.
No.
And you know, I think a larger consideration for us to be thinking about is, you know, obviously the CMBS market large in terms of CRE finance, the bank market, you know, multiples in terms of size, and you know, what might this, let's call it vagueness or inconsistency, or to your point, Darrell, that you're raising, which is it's really not so clear how out of the woods we may be, or, you know, may not be in some cases, and extrapolating that to the larger banking system as well, because while it's not a perfect proxy, the CMBS market, it might be a decent enough direction of what's happening in commercial loan books at banks, and that doesn't seem to be a lot of topic of conversation today, in terms of extrapolating, you know, special servicing rates, watch list rates, which remain highly elevated in CMBS land, despite some of the data inconsistency.
Oh, and the data, just to make sure you're understanding what I'm saying, the agency CMBS was much quicker to wave in forbearance with some of the less of the belts and suspenders that the CMBS special servicers might have taken in insisting on cash management. So it's going to vary on how they get worked out even. So they might be performing today and they might not quite have the same sort of surveillance on it at the different entity levels, depending upon the type of loan. So the banking sector, when you mention that, depends on how each institution handled it. It really could vary.
Yeah. So I think, you know, worth us all considering is that, you know, despite what is perceived as some good health of the banks, and by no means is anyone purporting that banks aren't healthy, is that there may be, you know, some more kind of gray zone loans than I think could meet the eye if CMBS is an indicator or proxy of what's happening in the CRE universe. And just given the magnitude of what CRE loan books are at banks, it's certainly something for us to be mindful of in kind of taking Darrell's data and observations and extrapolating them maybe to the larger capital markets. Victor, on the ground, the equity bid has been remarkably strong in some sectors, and in some markets. As well, you're seeing the debt origination markets also firing on all cylinders. So despite what is still an elevated special servicing and watch list, and let's call it gray market of, how certain loans are performing, there's been a very quick snapback in parts of the capital markets, equity and debt side. Where are you seeing parts of this play out, perhaps in some areas that you've been following, in terms of just the robustness of recovery that's happened?
I mean, this is fresh off the presses since we just updated our Q3 numbers earlier today, midnight thereabouts. We just recorded an incredible quarter for multifamily in 3Q, asking an effective rent growths of 7.5 and 7.9% respectively. Those are record quarterly growths, more than triple the prior record from 21 years ago at the height of the tech boom. And talk about recovering already, vacancies fell by 60 bips in the third quarter. So we're now at 4.7%, back to pre-COVID levels. Now, you're going to want to be nuanced as always with these things, because when it comes to certain segments of the rental housing market, like affordable housing, where you're capped on the rent increase side, say in LIHTC by HUD median income regulations, we actually recorded quite a low rent collection rate in large urban markets for affordable housing buildings that probably lost a ground floor retail tenant that made up 20 to 30% of their rental income, right? And so once you take a look at those idiosyncratic, you'll hear these statistics: multifamily, 90 to 95% collection rates, never fell below that. Sure, but once you look at specific deals and specific buildings, the picture might not be so rosy. Let's talk about hotels. I mentioned they were back to actually 64% occupancies as of the second quarter of this year. That astounded a lot of analysts, including myself, but that backed down to around 57, 58% as of the third quarter because of Delta variant concerns. So we're expecting hotel performance metrics to creep upward, sure, but very slowly. I think a lot of people are rightly skeptical about retail and office. We haven't seen the debt markets and originations fire back on all cylinders for retail loans, even permanent loans, certainly not construction loans, rightly so. We're not forecasting the death of all brick and mortar retail or that office workers will work remotely for the rest of time. But I think if you're an office or retail landlord or owner right now, and you aren't spending quite a bit of time thinking through how you can reposition or position your asset, given your changing mix of tenants and tenant preferences, you might be caught flat-footed. And we should be nuanced too. Retail vacancies are ticking downwards, but particularly so for grocery and pharmacy anchored neighborhood and community shopping centers. Mall vacancies declined about 10 bips, so it's falling somewhat, but are still stuck near record highs. And then as for property types like industrial and self-storage or even affordable housing, I'm not sure they even need a recovery period given how stable their performance metrics were throughout the last 18 months to 2 years. So back to you for now. Those are just quick takes on which sectors appear to be recovering faster, justifying what appears to be a 31% increase in terms of originations for multifamily and CRE on the debt side in 2021. And as an aside, Jamie Woodwell of the Mortgage Bankers Association, who came up with that 31% estimate, thinks that that's on the low side, right? It might be much higher than that. So let's see how it goes. Back to you guys.
Yeah, remarkable. Because obviously during COVID, summer into fall of 20, even this time last year, a lot of private debt funds, i.e., active participants in the CRE capital markets for sure, particularly in the value space, we're doing wholesale staffing changes. We're blocking and tackling recapitalizations based on their leverage structures, right? And getting into first quarter, second quarter of this year, complete opposite. Whiplash in terms of what was happening. Rapidly restaffing, deploying capital, having worked out leverage relationships with their money center bank capital providers, and then boom, Victor, to your point, voracious appetite on lending capital out of that source. Banks as well. Darrell, in CMBS, obviously there are a couple different types of CMBS markets. There's conduit, and then single asset, single borrower, and then CLOs.
Yep.
What are you seeing in terms of the translation of capital flows, liquidity availability, among those kind of pillars within the securitized markets, the Wall Street markets?
It's an amazing story, actually, just as you were describing how the private lenders have come back. In our world, the fixed rate product is not making much progress. You get a couple deals every month, maybe good for $1 billion or $2 billion worth of issuance. The real story has been about the floating rate loans and the take up by the borrowers and by the markets. So SASB is now hitting record levels of it will go through 50 billion in issuance. If you had told me that was possible in a good year before, that I would have said no. And yet here we have it. Everything that's in a portfolio transaction, whether by the three major players, whether it's KKR, Blackstone, or Brookfield, seems to go out there with a 2-year floating rate loan that's extendable for 3 or 5 optional 1-year periods, and just fly off the handle. Now, the spreads did widen a little in the last month of October because we actually saw 16 different SASBs priced in that month. Which I would have told you can't do that, but for a week apparently, and nobody flinches. So you would think that's the extraordinary story, but the truth is it's the CRE CLOs with over 31 different issuers this year and 38 billion of issuance by my tracking. I would have thought this market would never go above 20 billion in issuance. I think I had forecast on a stabilized basis, and now we have 5 new issuers joining out of the blue. They're achieving spreads on that product at the investment grade level that are like less inside of 140. The credit support to the BBB minus is like 81. It's financing 81% of their financing need, so it's 19% credit support or so. That's better than warehouse financing. So it's encouraging a lot of them to expand their books, as you just mentioned. And I don't really see what will change to make that any better. They don't have the same quality of electronic reporting that the CMBS market does. So the people who are buying this floating rate product have to open all sorts of trustee reports every month, go through them to see how the loans are doing. There's been a tremendous amount of mods within some of those pools. Anywhere from 20 to 45% of the loans receive some sort of modification. At some point you can only mod so far. So it's going to be, and so far the issuers have supported their deals by buying out the collateral that's gone sideways. So it's going to be an interesting story to see how that plays out. I was at the conference that they had for CREFC last week. Over 250 people attended that in New York, 400 online, and every banker and issuer was there. So in talking their game, so it's as much liquidity as you could imagine in that part, and yet in the fixed rate conduit business, not so great. Although I will say the last 3 deals did contain almost 30% retail loans. So, it's not close to retail. If you can underwrite retail at this point, and it looks like it's underwritten to post-COVID standards, you can probably start to place that into a mixed sort of conduit pool. The other thing we've been looking for is at what point do the borrowers decide that floating's not what they want and kind of all switch over to sort of SASB fixed rate, in which case that would actually feed conduit, because then we would start to see the issuers break up the senior notes into pari passu pieces and place them into various conduits. So it's been fairly dynamic in the response to COVID. Initially we had a few months where it just shut down, but now it's the Wild West for financing. I don't think that you'll find, I should qualify that the CRE CLOs were mostly multifamily supported this year. I think to the extent that they offer other products that the investors want to be able to monitor those products better. So, we are seeing some difference in pricing based upon the percentage of multifamily, just as Victor was highlighting. You don't seem to be able to go wrong with something that's got momentum pushing up rents at least 6 or 7% a year. It's hard to make mistakes.
Yeah. I mean, it's very interesting, to the point that you're raising with, retail and what the proportion of that would be. I think obviously running counterintuitive to many, perhaps that retail is more necessity retail. But I think TREP even released some stats that, kind of office, given the big question marks that remain, particularly for major city office, has been diminishing in CMBS conduit. And strangely, retail has eclipsed it, at least on a couple of most recent deals. I'm not close enough to figures to actually vet that, but it was interesting to kind of hear that.
It did. It's like twice, Don.
Yeah.
The office has really come down. Not much. I do have some. We do track that from year to year, just to give you exact numbers. I think we're less than 10% on the office. But,
incredible, right? Because that used to be a very large amount of ballast, particularly if you looked at like Manhattan office, right? For fixed rate deals, the top 10 loans. Or San Francisco or Los Angeles, like kind of what would be deemed as kind of core-ish office, and now it's very difficult.
And I'm not sure that it's driven by the originators or the actual borrowers who want to see more certainty. It's like sometimes a market will shut down when you don't have good conditions and you'll hold back. And let's say you're the owner borrower who thinks they can actually see their way through this work from home thing, and that in 2 years' time they will be much better. They may try to delay it and that refi. Whereas right now, the amount of acquisition loans going on in multifamily is going to drive a lot of volume there. And then the retail, to the extent that they can finance it, if you have something that underwrites you would be foolish not to go. So that could be part of it.
Yeah. And it'll also be interesting, obviously, to see, what's happening with these large regional mall loans that were, call it CMBS, even 2.0 originated, right? That are going to be coming up for their maturities. Those tend to be pretty large balances.
Yep.
And where do they find their home, right?
Yep.
It's probably not going to be a rollover.
We have seen some SASBs roll over that were retail this year, but it depends on the asset. It really has to be a destination mall that can clearly show a strong rent roll, strong sales, that sort of thing. You can still put into a SASB and let it stand on its own. And I think the investors appreciate it because they can underwrite it themselves. But there are other malls that were made where loans were made that I think are weaker borrowers, weaker locations, that are kind of suffering. I track in the next year almost $1 billion of CMBS mall loans coming due. And then in the following year, another 960 or so. And those are just below, so that the billion is less than a 6 debt yield right now, if you can imagine. The other 960 is just less than 8 debt yield. So these are situations that will have to be restructured or, and honestly, the servicer's response to COVID was, well, it's not going to be any great thing in my hands. I've done workouts myself, honestly. I would not be the first person to go in there and try to take over the mall. And I'm thinking the special servicers in CMBS have learned that they can't usually operate the mall any better than the current owner. So they shouldn't be in any rush to do it. So that's why you're seeing a lot of forbearance used there. But they're going to have to keep pushing that forbearance out to see what the final real economics of the mall is. And it may settle that it's not any better than it is right now, in which case you will see some sort of, at some point, forbearance loses its ability to make up for something that just doesn't work anymore.
Yeah, and I think
just quick for malls in particular, and for other property types as well that are kind of on the ropes right now. The average has really never been quite as useless right now in this particular pandemic. It's really more the range that you're taking a look at, right? It's the cliche. It's a world of have and have nots. When my wife picked our home's location back in 2017, when we were moving out of New York City, I was slightly terrified when I found out that I lived 1.2 miles away from Short Hills Mall. Now, Short Hills Mall is probably characterized as not quite a low income mall, and they're they're doing fine, right? They're doing fine. A recession and short-tail small.
Clearly, you would refinance, Victor, just
Yes,
based upon your wife's shopping habits, I'm sure.
I think so, right? I mean, what is a recession in short-tail small? 15 Teslas as opposed to 20. So it's such an interesting world of have and have nots, where you drive out 10, 15 miles away, you're thinking it's the same trade area, but it's not, right? There are other malls out there that aren't doing anywhere near as well. It's such an incredible landscape.
We have a mix of leverage even on the good malls. Like, people would think Mall of America would be easy to refinance. I don't think so, and then you start about talking about, it really is, as he says, haves and haves not. Like, I do have $3.5 billion of malls that still have a debt yield over 12%. So it really varies by property. And like the Ala Moana Mall comes up next year. Do you think it's going to have trouble refinancing? No. Howard, I got to tell you, I already know where all of our wives are going. It's Hawaii, and it's probably going to cost us.
Yeah, and I, and to that point a little bit, Darrell, as well, is, when a loan does get liquidated by a servicer, right, particularly regional mall loan, and you look at the severity data, right, so non-performing loan regional mall, very rare for it not to probably be at least an 80% loss. I mean, when you really look at the data, right? I mean, a couple outliers here and there, but I mean, every time you see the high loss severities, it's like mall after mall after mall. And a lot of these malls aren't necessarily the, middle of Iowa trade area, with 30% occupancy. Some of these things looked and felt like real malls just 5 and 7 years ago, in terms of the obsolescence of kind of what we're seeing there. So, I think the point that we're probably percolating out here is, we've got some ambiguous data still coming out of, commercial real estate loans from CMBS and what the performance is. We've got, haves and have-nots of liquidity on both the equity and debt side. And we have, what could be some looming very large maturities of some assets that aren't really going to be in favor for takeout. And what's the, where do they find a home? And who thought that an office, right, which is probably a proxy for commercial real estate liquidity, would be like Manhattan office, right, is almost like a no bid zone, right? The fact that you really, the borrowers don't want it financed and the lenders don't, it means that there's probably some disconnect on valuation, right? And that means that there's a real inflection point that's kind of, playing out there. So it's interesting, right? Yet, we've got a ton of debt issuance happening, right? And Darrell, I was not at all aware of how high that mod activity was within CLOs.
Yeah,
I don't want to,
there's six over 40. It's tough to track even those numbers, so you just don't know.
It's and these are all new securitizations, i.e. new vintage loans. And while, some forbearance activity related to COVID, I think is not to be unheard of for sure. There's probably a correlation between mod activity and loan performance and ultimate recoveries in some way. And if you're seeing this modification activity out of gate, just something probably to be mindful of, particularly if it really isn't legitimized to a COVID related, item. And then how
we don't know.
Right, because the data, to your point, there's not enough transparency in the remits, is what you were saying. So to actually really understand what happened with that modification. So that's interesting. Yeah. It's really interesting. Okay, so clearly we've got a pretty mixed picture out here of, despite there being a lot of ebullience in the markets, that we've got to be pretty thoughtful and mindful of what's happening in some of these structures, and where some of these signals could be pointing in this gradual exit out of the conditions that we're in. So, we've kind of danced around this a little bit, and I know that there's a lot in the popular press and even in the real estate press around kind of where, effects of CRE are going to be, based on this rapid amount of change that we had, both in sentiment and actually modality of how property is used. Victor, I mean, maybe outside of the conjecture, anything, in terms of, your own thoughts on where this begins to really shake out for for the BRICS.
So you're not just near-term effects, but possible intermediate to long-term effects, right?
Sure.
Again, I think we've hinted at this throughout the discussion, but COVID-19, I think, accelerated a lot of trends that were already present and or forcing different asset classes in commercial real estate to evolve. We were at under 1% e-commerce as a share of total retail sales back in 2000 when the US Department of Commerce began tracking this 21 years ago. That crept up to the 11s over 2 decades, but then jumped to 16.1% in the middle of 2020 in a single quarter, about 10 years worth of evolution, right? When, we didn't know when this pandemic would end. Office space utilization per office using employee had been cut in half over the last 40 years. We used to bandy around a rule of thumb that we'd say, how much space would you need per employee? You'd say 200 to 300 square feet per employee. Sure, that was operative back in the 80s or so. But if you divide occupied stock per an estimate of office using employees in 2019, we were at around half that, 126 square feet per employee by the end of 2019. We haven't brought this up, but it's also interesting how COVID, I think, forced us to look at alternative forms of data a little bit more closely, right? I don't think any of us really took measures of physical occupancy that seriously before COVID. As long as the tenant was there and it was occupied economically, then we cared more about economic occupancy. Who cared how many people were occupying that space on a daily basis? And now the talk is of, are people going back to the office? Depending on which data source you consult, whether it's swipes of office ID and the like, we're at around 20 to 35% in Manhattan, right? And it was around 62 to 65% before COVID. Let's face it, we were never all in the office 100% of the time. Interesting statistic from the tech company called Slack that I've worked with. Apparently, before COVID, only 50% of their employees were in their office space at any given time, right? And of the 50% that was in the office, only they spent, I'm sure they were rounding this off, it's way too round, right? Of those 50% that were in the office, they spent only 50% in their actual desks, right? Because you were milling around, you were at the cafeteria, you were in meeting rooms. And so what is the true use of office space? My suspicion is we've already been trying to figure that out before COVID, and COVID has basically accelerated that. Furthermore, if our economic projections this year and next come to pass, we'll have US GDP growing at rates we haven't seen since the early 1980s. I think Darrell noted this also earlier on. It's almost as if we needed this COVID black eye for the US economy, at least to look even better than the 2% growth rate engine we had in the last decade-long expansionary period. So I'm not sure COVID really prompted any significant new evolutionary force to exert undue pressure on different CRE asset classes, more so than really adding an accelerant or more fuel to the fire that had already been burning for quite some time. We were already figuring out how to monetize fallow space, right? You had small CRE-tech or fintech startups like Convene coming up to you saying, I know you have an office lease at 7 World Trade Center, but I also know you don't use that giant auditorium more than twice a year. Why don't we partner up so that we can use it for events and you get X% of any revenue we raise, right? And I think that's just going to continue. I think we're going to start rethinking real estate as a fixed asset class. I think in accounting terms, we still call it fixed assets, right? And we're going to try to figure out how we can make it a bit more flexible given how things are changing so quickly around us. Warehouse to office, office to apartment, logistics to life sciences, I'm not sure. And I think the more flexible real estate space are the ones that'll come out the winners here in the long run. Back to you guys.
All right, Darrell. I guess maybe translating a little bit of this sentiment of the, let's call it the accelerant, because I think, Victor, that's a great way for a lot of people to really understand what happened here, is that it wasn't a singular catalyst, but it certainly accelerated where change was going to a tipping point, right? I think the corollary, for how office usage and modality might look is basically how people chose to shop, and the tipping point of that in the 2011 to 2014-ish period when adoption rates of online, so that seems to be really kind of a tipping point in retail. We probably had a further tipping point when people were forced to explore picking up their groceries, via an online order or whatever. In the office space, this accelerant, we could be at a tipping point of where there was some change, right? And it really just accelerates where this change goes. What's interesting, to me is there have been many large companies that have been operating in this, call it nimble environment for quite some time, and doing remarkably well, and to, maybe play devil's advocate for just a moment on that is, you look at the big four accounting firms, and so the management consulting firms, as agile organizations that really through the early 2000s, for the last 15, 20 years have been operating in this agile environment that everyone's thinking that office is going to, and have had remarkable employee training, employee retention, employee mentorship, long tenures of people building careers. And the conjecture around the fact that, it's impossible to operate in some of these agile environments, is that all within the office realm, in the corporate realm, can look to some examples of some places that have actually been doing it for quite some time well, and how can we learn and extrapolate from them, because they kind of didn't miss a beat during any of this, and it really played to strengths that they were already developing. So it could be interesting to see if we begin seeing some translation there. Darrell, on the CMBS and let's call it the structured and the securitized and the Wall Street side, are people really understanding this, or do you think?
I think you're seeing some understanding, but when you say accelerant, it's not a good term. It's not implying that the outcome is going to be much a wonderful thing. I've been through 3 retail cycles or down cycles. In every one of them, the owner of the property lost the property. It got sold for another price that allowed the new buyer to reinvest capital to recycle it. So yes, real estate's supposed to be able to evolve to these next things, but every time there's capital required to actually get it to what it's supposed to be. So, well, it's nice to talk about the nice terms of what it's going to evolve to. At the end of the day, that money is coming out of somebody's pocket. And I look at several, and we as analysts looking at the sector, we go loan by loan, and we'll come across situations that say, okay, that mall was great. It's not going to make it. We've got 2 anchors out. I've got the inline is sucking wind. It's got to be turned inside out. And as soon as you start talking about out parcels on what was an inline piece of retail, it's a lot of money. Movie theaters don't demolish themselves. So in my experience, we're definitely looking at situations where the borrower is going to come in and try to do some modification with the special servicers as they can't refinance. The severities or the haircuts required are going to get quite large in some situations. And it's not just retail. So the evolution of retail is going to happen, but it's going to cost money. I would say the same is true of several Class B office buildings. There's been a lot of leasing since COVID started, but it's all these new wonder buildings that are zero emission, and it's going to be built just perfectly, and it's going to have all this stuff, and the plants are going to pet you or something. It's hard to imagine all of the things that are going to wonderfully exist in these new office buildings that are supposed to happen. But if you've got one of the older ones on, Midtown South that you just lost the tenant and they expire in December, and your mortgage comes due in, I don't know, I'll just make this up, March, you might be in trouble. And nobody's willing to bet on that, even at some of these rates that would have been a no-brainer 2 years ago at $500 a foot to acquire that thing. Because you're going to have to come in and redo all of the HVAC. You're going to have to redo all of the space. It's going to have to be this wonder space. It's going to take money to do this sort of evolution to where these things are going to. Some of the hotels may get converted over to residential as well, because there's always demand for. So the severities there on hotels that can't make it will probably be a little less than some of the other products. But you're right to point out that when a regional mall is in trouble, it's an 80% loss, or in one or two cases already over 100%. And there were a lot of malls that were done in 14 and 15 that I would have told you, that looks like too much leverage, or the operator doesn't have what it takes. And the same for the office. I saw a lot of offices done with leases that come very close to the maturity. So right now I keep a list of loans that are due in the next year that have major leases rolling over the next 36 months. There are definitely extension cases, and depending upon how these tenants downsize to their new special space, potentially defaults and severities.
Yeah, and we're seeing some of this, in our own loan book as well. To your point on functional obsolescence here.
It's like when they told you, remember industrial, you can't have anything less than 30-foot ceilings. Office, it's all going to be zero carbon footprint, because there's no major tenant in the world that's going to tell us shareholders it's putting out carbon. So it's really a big change.
Yeah, and I think it's a very interesting point, Darrell. One, I think even a lot of boots on the ground and people in a lot of these markets don't yet appreciate here in the on the at how large that sentiment is, how quickly it's changing, and really how multinational a lot of these decisions are getting made. On the tenant side, even if you're a US-based Fortune 1000 company, they are making decisions today based on scorecards and metrics that are very real, and it's not having two parking chargers, two chargers in the parking lot and some bike racks. That's not ESG or sustainability, or even just having LEED Gold is not necessarily what it is. It's really fundamentally about something else. And to your point is you could effectively have the equivalent of non-cross-docked 18-foot industrial buildings, i.e. office buildings that are not at all really adaptable, absent substantial capital investment, that very rapidly become functionally obsolescent. Just like the regional malls that don't readily have another purpose outside of massive capital programs. And I think a lot of people, on the ground, even in the office space, even in sophisticated markets, or lenders really are grasping at what's happening here, and it's playing out in globally, and could play out in large force. There's certainly going to be room for those investors who get it, right? Because there's probably going to be a large enough arbitrage to supply product for these users, and potentially finance those projects, and then those that just don't. It will be quite interesting. And even getting into this point, a lot of people think this is squishy, but at least I'm of the view there are real dollars out here on ESG and how companies approach it. It's a point that is very much coming front and center. It doesn't really feel like it's an adjective or page 32 of a deck anymore. It's front and center on some decisions. Victor, what are you seeing kind of play out on how users, finance sources, and even capital sources, right? Sovereign wealth, pensions, right? I mean, here we are in the US, and a lot of the investment activity here is driven by investment sources that aren't necessarily US based and are progressive on thinking about climate. So, how do we translate that into some things that you're seeing in the market?
As one large lender client told me maybe in confidence, about a week and a half ago, at least I now know what ESG means, or at least I think I do. So kidding aside, I do think there is much greater recognition, as you noted, Don, even relative to 5 or even 2 years ago, of how to think through things like climate risk or physical risk, how to quantify things like transition risk, for example, which may well be the immediate concern for a lot of commercial property owners and landlords. Partly this is because of, as you noted, regulatory pressure. You've got Local Law 97 in New York City imposing relatively hefty penalties if you don't retrofit your older commercial buildings to meet certain standards. But as Darrell noted, what if it costs a lot to upgrade entire HVAC systems and the like? Should you just pay the darn penalty? Well, how do you even know which number's bigger? So there's incentives on the regulatory side. As you noted, Don, increasingly so in the US, the EU and other countries and regions are further ahead. But there's also incentives on the investment side as the BlackRocks of this world launch ESG-focused funds. A week and a half ago, thereabouts, Marsh McLennan worked with 4 large insurers to offer better terms to clients who have higher ESG scores. That was just announced in the Journal in an exclusive last week or so. There does feel like there's a confluence of pressure across many sides that are now prompting CRE market participants to figure out just what ESG means for their business. I think that we've made much more progress on the E side as opposed to the S and G side. But one big question, for example, would be, if you're an ESG focused fund, should you own Facebook, right? Or Meta? I don't know what they're called these days, right? I suppose that's more on the G side as opposed to the, and who decides on these standards and how to impose it? I think that conversation is important. Absolutely. That's what G20 leaders are kind of trying to figure out right now, right? And I think it's still ongoing. I don't think the rules have been settled just yet. That's what a bunch of subcommittees that I participate in and the CREFCs and MBAs of this world are trying to do, right? It's a good conversation to have. I don't think we're there yet in terms of a really standard playbook and something to follow, at least on the performance metrics, rents and vacancy side. Darrell, what about you? What are you seeing?
I speak to a lot of people and on the who are the landlords and they're facing a reality that if it's a Fortune 500 company, they really have to be able to offer something that's going to be absolutely 100%, at least a LEED Gold building, as Donald mentioned. But if there's something better, they won't be, in a few years, they won't be caught dead in anything less. So it is leading to this sort of, you can't quantify it, but it's going to be something where suddenly these buildings are without entire new interiors and HVAC and windows are in trouble. So it's just a matter of how sudden this has come upon everybody. But it's not much I can say. It's something we'll look at. And bets that looked good before COVID today don't look as good because you throw in how much work from home may take, and people do the math on, okay, my guys and people all want to stay home at least 2 days a week. So I'm going to be reconfiguring the traffic flow. So I won't need as much space. So we have something that's going to roll out through, I think, the next 24 months as we actually return to whatever that new normal becomes. And that utilization is going to be tough to estimate. And then, of course, those tenants that roll over in the next 36 months, we'll be seeing the first sort of signs of how much they actually downsize their space on their lease that they formally sign. And I think given that, they're going to be upgrading to the better buildings. So it comes back to those have not comments you made before, Victor. There's going to be have buildings, and there's going to be buildings that aren't in great shape, that need to be recycled in some way.
I don't think there is a standard, right, in terms of just what to impose.
But because there isn't, if you're the management of that large 500, if S&P, whatever the company is, you're going to err to make sure you get the best space you can. So it's going to be this rush to Hudson Yards away from 6th Avenue. And
Yep.
You're going to see these sort of real shifts that unless the landlords can come up with the capital to make the pitch that they can reconfigure the space, they're not going to have as many tenants as they had, and you'll see sort of the actual asking rents that they're able to ask for change as well. Like we saw one building trade during COVID, and a major investor thought that they were making a good bet at probably $550 a foot in South Manhattan. And now you look at it today, and it's just like in the last 6 months, the whole equation changed.
Yep. I hear it. And
it's not a recession. It's just a change in the demand and how it's going to be bifurcated.
Yep. Do we really even want to call it a recession at this point? Is it not the
No,
short
it's
recession in history, like 2 months or so thereabouts, March to April of last year?
no, it's not a recession. I don't think I can call it that. It's just a change in the demand.
Yeah,
So-
it's quite interesting. Sorry, I dropped off, and here's one of the downfalls of this remote working environment is Wi-Fi, right? Let's hope maybe the infrastructure plan might address
That's right.
some more reliable, like, I don't remember the last time water stopped flowing into, my house, but Wi-Fi seems to be even the more valuable utility.
Don,
so-
the issue you brought up was interesting. I learned a
Yeah.
different definition of UPS because of this pandemic. It's not United Parcel Service. I figured out what an uninterrupted power supply was in this pandemic. And trust me, at my feet right now is an
Yeah.
UPS where I've plugged in my Wi-Fi, my monitor, and my webcam just in case. Just in case.
Wow, that's remarkable. Okay,
Wow.
that is something. Okay, we've got Victor in a bunker
That's
out in
right.
Short Hills.
He's
where to
prepping.
go. Yeah. All right. Okay. So I know that we're up against our target here. Justin, is it worth bringing in maybe some Q&A or some chat from those around us?
Sure, absolutely. Glad to. Kind of sticking with the topic we were just on with regard to green building, I had a question come in. So early on when LEED certification, et cetera, was first becoming a thing, the rent premiums were just crazy, right? For the people that wanted to be in those buildings. What it seems like I was saying is that has not really changed. Like 15 years on, it's still that way. So the question is, given that retrofitting is not always going to work, right? Just the cost factor. What's the equilibrium? Like, when do we get there? Are these rents just going to keep going and going and like the Energizer Bunny, right? Do they just keep rising?
I'm not the expert in real estate demand, but based on the demand that we're seeing and how it's outweighing what the supply can be in the short term, demand could be another aspect of this supply crunch that people haven't anticipated yet. But I'm not an expert. I used to be an office researcher 30 years ago, but if you look at how many people are going to want to swap that, I think you've got to say there's going to be upward pressure on those rents, and people will pay for them to get it because they have to have.
Victor, what are your thoughts?
Well, that usually as an economist, I'd be a proponent of choice to go and say, look, if you can't afford the swanky new office building, there ought to be choices for you at lower rent levels. But if there is a universal standard coming where larger, better capitalized companies are flocking to the higher quality, LEED certified, ESG compliant commercial properties, that sounds less voting with your feet to me than adverse selection, right? In other words, it's going to be that world of have and have nots again, where you got lower quality companies, I don't know, less capitalized ones, fly by night in the dankier office buildings that because that's all they could afford. And then you're going to have clusters of neighborhoods of super high Delta variant, let me not do that. Super high rents in the Hudson Yards of this world, where they are in their enclaves and they can comply with ESG standards, right? And I really wonder where this will all play out. It's really quite interesting because unless a government entity is willing to subsidize the older retrofits, I don't know if we can afford this. I think that's what Darrell's also saying, right? I'm like,
yeah, I don't think we're disagreeing here.
The richer, the better capitalized properties that can charge higher rents to offset the higher costs of ESG compliance will be fine, right? But what about all those other properties? I don't know, by Wall Street thereabouts, by the South area that actually needs to be raised above sea level because they're actually below that relative to the East River. That's a major investment. Just tear it down. Just tear it down, right? And yet
Yeah,
it
there are.
costs billions.
Yeah, there's a certain amount of tenancy that, as you point out, has to go somewhere, though, right? So they'll get tenancies. It's just the demand and the rent levels they'll be paying is a lot less, and then we'll have to spend a lot of money to convert that, whether it's a redevelopment, as you say, in which case that's loan losses for some people.
Yeah, there's a lot of time for this to shake out. However, there's not a lot of time for loans to mature and be resolved. And
Exactly.
so ultimately there could be some, orchestration of the next, 10, 12, 15, 20 years of how this, really begins synthesizing. But that's hard knocks when your loan's up for maturity in 15 months. And there's not a lending universe out there to really take some of this stuff out.
Well, I forgot to mention one of the interesting things, Don, we saw during COVID. A lot of loans that were offered forbearance by the lender in CMBS didn't take it because the subordinate lender didn't allow it to happen and took the loan and worked it out away from the CMBS market. So the leverage is already, acting as if it was an option to buy.
It's very interesting.
All right, got another one that's come in, turning away from our topic there. This is aimed at you, Darrell. So a while back, you said something about underwriting to post-COVID retail standards. There was some interest in what does that change look like? Like how much has that shift happened? How much of that shift has happened?
That is going to have to reflect, assuming that these tenants aren't in there, so you go through the rent roll and clean out the ones that you are absolutely sure aren't performing, or the ones that have been on 1 month to month don't get counted in the rent roll. And if your numbers still work and give you an 8% debt yield, and it looks like the vacancy in the area is still a destination sort of location, and it's still going to be able to make it, and you just count on a couple of extra sort of leases to get you there. Then if it pans out at that, whatever that number is, if it's 70% occupied or 80% occupied, once you net everything out, then that can be refinanced. You would think that's a natural, by the way, for CRE CLOs, but they've been trying to stick to their multifamily and away from retail. So I think it is really sort of private lenders that have been stepping up a little with an eye to that sort of upside, and it has been tough. I think a lot of it will still remain in sort of getting further extensions until we really see where it stabilizes. So this wall of retail we see coming, which I counted at 2 billion in the next 12 months, there'll be a bunch behind that in the following 12 months, and it will start to build up to the point where, we had one of the largest economic recoveries ever, where we'll say, okay, if we see the downturn, you can see some real risk to that. So a lot of the investors in our markets are really pricing it as if it's going to take some sort of loss, even when it has a decent type debt yield and a decent carry right now. And that's kind of the exercise we go through when we look at the bonds. We'll look at every little retail and sit there and go, okay, it looks like it can carry through to maturity. Then it's going to default. They'll get 36 months, and then we're going to go hit this thing. You're making those sort of assumptions. There are the loans that are just that one level above that, where you're going to do the mark to market on the retail, and you're going to say, okay, it can carry something reasonable, and I like the location, and I think it's probably going to be one of the ones that will come out of COVID. So it's not too different than that obsolescence discussion we just had on the office.
All right, one more. So the accelerant term, that went over well, Victor. That was a good term. So the accelerant provided by COVID, in terms of office space, kind of making things go faster towards this shared space and et cetera. you guys talked about it. This is actually my question. I'll be honest. I've heard a lot of people.
Your friend had a
yeah,
question, Justin.
asking for a friend.
Yes.
Right. I've heard a lot of other people make that same argument. I've read several folks kind of making the case. Do you guys are plugged into these kinds of conversations? Do you hear anybody making the opposite argument? Like when we all come back, right? We're still saying when about that. When we all come back, I don't want to sit at a desk that somebody else sat at yesterday, and I don't want to be in a shared space. I want to be in my space as much as I can make that possible, and get away from this whole idea of
you mean
right?
you mean when I have this wedding photo from 21 years ago, I can like leave it there and not take it home with me that
For
night?
example, yeah.
21 years and 21 pounds ago. It's very symmetric, actually. No, I'm with you, Justin. I've heard both sides of the argument, and the argument that you just noted is an argument about the unanticipated costs of the distributed workforce, right? That's a fancy way of saying you don't know what you're getting into if you really open the doors towards a fully distributed workforce. Really? What about tax implications and accounting implications? Are you okay with lowering the tax rate and the pay for folks who move to lower tax states? Because that's going to be a discussion, right? Well, what about folks who have differential H-1B application standards? You're more lenient in your San Francisco office as opposed to your New York office because there's more pressure to hire foreign workers in the West Coast techie type jobs, right? These are things that I'm not sure a lot of folks who haven't had the experience have really thought through. It's nice to position yourself as an enlightened employer. But I think the only thing we're 100% sure of these days is that employers are going to make mistakes about what their employees really think. You know, those surveys that they ask you, where do you think you should go? You're going to work from home or work from... My suspicion is a lot of employees are wondering what their boss wants to hear, right? And then what happens is once the office is really open, let's actually see experimentally, empirically, whether or not people come and utilize that space and how they do it, right? And then I think, folks who have office leases can make a decision a year or two from now, whether they need that much space, need more space actually, or need less, which is why I'm decidedly fence-sitting on my office vacancy forecasts, right? We're keeping it slightly elevated and or flat over the next couple of years as this shakes out, because if the record high resignation rates are an indication right now of where employees are going and whether or not people are happy with the world of work post-COVID, I don't think anyone has an answer yet, right? And by the way, as leaders of your individual business, you're going to have to set some kind of policy, right? And you may have to decide, okay, we'll accept if X people don't agree and they have to get off the bus, or this is just our quote unquote, our culture, where an in-office culture, or as Don noted earlier, you got consulting firms that seem to have anticipated this and are doing just fine, thank you. What about McKinsey as a 4 days a week on client policy, right? That means their physical occupancy of McKinsey offices is 20%, right? Even before COVID. Or I don't know how you count that. I guess they were in their clients' offices, right? So it's such an interesting thing. And I'll tell you right now, though, there is one company that's betting that you're going to make a mistake, that you're going to shed too much office space, when in fact you needed more. And the name of that company is WeWork. And they just went public last week, right? No, October 21, right? Hey,
did you buy that? Do you have the shares, Victor?
No. In fact, they're down. But it's interesting because they hired a veteran real estate guy to be the CEO, right? Sandeep Mathrani ran GGP and Brookfield's retail portfolio. So, I get it. We remember the former CEO from the Netflix and HBO documentaries, right? He still owns 11%, by the way. But like WeWork's business plan is literally, hey, flexible office space because you shed too much, right? I think so.
I'll just weigh in as a credit person. We have to anticipate less use, and we always assume there's a recession happening. It's just the way we are. Like we only, for CMBS analysis, I only have recession scenarios. I may consider the upside in a couple cases, but we tend to be a fairly negative bunch in the credit world.
Yep. And maybe now, and to get us toward a wrap, Dr. Benefield, maybe now, Darrell, we also need the inflation scenarios, which haven't been dusted off for a long time. I think probably don't make it in the HERF modeling, so much. So it'll be interesting if this isn't so transitory, and we really see some stickiness on inflation and kind of how that might measure in, because it's tended to be kind of a given, for most of our careers, and all of a sudden it's looking like it might really be something. It's if real estate is a bond-like investment, and bonds tend to do varying degrees of kind of performance in parts of an inflationary cycle. Even if some of these bonds are like industrial assets, it could be interesting to see what starts playing out even in the darlings, among the asset classes. Okay, wow, we went a bit over. Darrell, Victor, thank you for making some time for the program. We certainly have a lot of people that tune in that weren't with us live on this. So thanks for investing your time, with the program and in doing this with us. And thank you also to Moody's for making you both available to do it for us. And Dr. Benefield, I'll turn it back over to you.
Thank you. Thank you to you too, Donald. So thank you to all three of our panelists for joining us tonight and sharing your insights. And thank you, everybody out there in the interwebs, for joining us this evening. We wish you well. And this concludes our 2021 Capital Markets Forum event. On behalf of Auburn's Harbert College of Business and the College of Architecture, Design, and Construction, thank you for joining in, and War Eagle.